Cool. Hey everyone, welcome to our first session in this year's New Zealand Chinese Trade Association Young Associates Development Series. My name's Alan and I'm currently a part of the operations team within the YA. The development series is a new series for students and young professionals to develop and learn skills in specific areas. We hope that through the series, you'll be able to gain tangible skills of your employability, numerical literacy, as well as being more comfortable in social situations. So over the next month, we'll be hosting several events. So keep an eye out on our social media by following us on Facebook, Instagram, LinkedIn, and WeChat. You can also subscribe to our Patreon, access to exclusive content such as this, and also discounts to our upcoming events. And that's only at a cost of less than $3 per month. So for our first part of the development series, we'll be discussing financial literacy. While not everybody was able to do commerce at uni, it's very useful in the professional setting to have an understanding of numbers and financial statements. This is a very important skill in terms of investing and your everyday work. Additionally, while taxes is thought to be such a big and fearful topic, is it really? Having knowledge of these skills will be quite useful in your daily lives. So in this session, we'll be going through basic skills to understand and read financial statements and how a company is operating financially. We'll also be touching upon the New Zealand tax system and also the different taxes that affect your everyday life. So within the next hour, you'll be learning from some of the best in the field. So without further ado, I'd like to introduce our two speakers for tonight. Helen Hay, who is part of PwC since November 2017. She's currently progressed her way through to a senior associate role in the FAS team. Helen works for many key New Zealand corporations and international clients in all corporate tax matters. She also has developed a keen interest in mergers and acquisition and has been working on more than 10 pieces of tax due diligence since early 2020. And our second guest for tonight is Martin. Martin is a transactional services senior analyst at PwC in Auckland, specializing in mergers and acquisition financials, due diligence. He's also part of the Chartered Accounting of Australia and New Zealand. Prior to his current role, Martin has had 3 years external audit experience in a variety of industries, including energy, telecommunications, and technology. He's equipped with comprehensive skills in international financial reporting standards and business acumen of Australia and New Zealand entities. So I'd like to pass it on to Martin, who will go through the first part of the seminar.
Hi everyone, my name is Martin and thanks for the introduction from our YA team. So today I'm gonna talk about something about accounting, but not everything about accounting today. So yes, just like what the introduction mentioned just now. So today our workshop will be divided by 2 sessions. The first session will be my session. I will talk about the accounting side, and the second session will be Helen's session, and she will talk about the tax-wise. Cool. So now, if we look at the slide, and also, let's take a look at the content today. So like what we just mentioned, so the first 3 subsections, it will be my session, that's basically talking about accounting. And the second session, it will be Helen's session, that's talking about the tax. So in my session, so basically there are 3 subsections, right? So the first one, I'm gonna give you guys a really broad and brief introduction about accounting, like what is accounting, and what accountant is doing every day, and what's the different types of accounting. So why some accountants they prepare financial statements, but why some accountants they do budget and then they do financial analysis. What's the difference between that? So that will be so you will find out all of the answers in the first session. So what's accounting? And then the second session, it will be talking about financial reporting. And then, so in here, we will basically talk about the 4 typical financial statements. You will, which are really important in the business world. So basically, the financial statements that CFO and CEO will be looking at every day. And then the third part will be we're going to introduce you guys some financial ratios. That's also really important because the financial ratios is going to help us to identify the real problem, and then so it can reveal the real problem. But based on the numbers in the financial statements. So that's really important for us to understand these financial ratios and to make business decisions. And also at the end, I'm going to give you guys a little practice on how to use these financial ratios. Cool. So now if we look at the first one, what is accounting? Cool. So accounting. So here, if you look at the introduction here, so accounting is a process of recording financial data and generate the financial information for decision makers. So here there are three really important elements here. The first one is data, and the second one is information, and the third one is decision makers. So what is data and what is information? And then, so what's the difference between those two? So data, you know, so in the current business world, the business, they are facing a lot of data, like every day. And then the data, sometimes data can be like gigabytes and, you know, like, so millions and millions of transactions a day. So, but data is, so sometimes, so data is really important to the business, but it is only important after we process the data, because after processing the data, and then we can generate the financial information. So this is what accountant is doing every day. So the accountant will collect all of the data, for example, like the sales data, cost data, inventory data, and etc. So accountant, they are going to collect all of the data that incurred in the business a day, and then they're going to process the data. So, and then to generate financial information, and then the accountant, they will provide this financial information and also the financial ratios and financial analysis to the CFO or CEO and to make the decisions. So that's basically the really simple definition about accounting. Cool. So now after that, we need to understand what's the different types of accounting. So generally speaking, there are two types of accounting. The first one is financial accounting. So another type of accounting is management accounting. So from my perspective, I normally understand these two types of accounting in this way. So I like to say financial accounting is more for external, and management accounting is more for internal use. So if we take a further look at this, so what is actually included in financial accounting? So financial accounting that basically generates interim and annual financial statements. And this is going to be our focus today. And then what is in the financial statements? It will be in the that includes balance sheet, income statement, and cash flow statement, and also the equity statements. But don't worry too much about that. So that's not our focus today. So, but today we will basically talk about the first two reports, balance sheet and income statement. So that's the financial accounting. That's or in other words, the financial accounting is a really standard report. So that's complied. The financial statements is prepared in accordance to the international financial standard. So it's really a strict standard. So normally the management, they will prepare, the management accountant, they will prepare the financial statements, and which will be normally audited by the accounting firms like us. So and then that's a really standard format, and then everyone can read it, everyone understands what is included in the financial statements. So that's a financial accounting. And then on the other hand, so in terms of the management accounting, there's no standard. It's basically for the management internal use. They can do whatever they want. They can analyze whatever they want. And then the report can be in whatever different format. So that's really subjected to the management and the board. So, and what information the management they are interested in. So they can do whatever they want. So that's basically for their internal management use purpose. So what type of reports would be included in management accounting? So that normally includes budgeting, forecasting, also some other financial analysis, like cash flow analysis, like working capital analysis, debt analysis, those kind of stuff. So, but don't worry too much about it. It's not our focus today. So you just basically need to know there are two types of accounting. The first one is financial accounting that prepares financial statements. It's a standard one. And another one is the management accounting. They prepare budget forecast, which is for the internal use. And there's no specific format for that. Cool. So after that, so we're going to talk about the second part, that's financial reporting. So basically that's the 4 different types of financial statements here. So let's quickly take a look at the 4 different types of financial statements. So that includes income statements, balance sheet, statement of cash flow, the statement of equity. And let's quickly introduce you guys explain to you guys what are these 4 different types of report. So first, income statement. You just only need to know this tells you the profit, how much the profit will be generated by this business during the year. So that's telling you the profit, okay? And that's really important. Of course, everyone has to care about the business profit, right? Because if the business not running profit, it's not good. Because what we want as a shareholder, we want to, or as a management, we want the business be more and more profitable, right? So that's what you can, that's the information you can get from the income statement. And then, cool. And then the second one will be the balance sheet. That basically tells you how much the assets, liability, and equity in this report. And then it's more like, it's also known as the financial position. So there's a position, so asset to the balance date, and what's the position of the business? How much assets the company is holding, and how much liability this company is owing. Yeah, and how much residual interest left to the equity owners. Cool. So that's balance sheet. Oh, sorry. I think I also need to mention, I forgot mentioning this one. So income statement is also called financial performance, because that's the performance. It means how much profit they performed during the year, right? So that's really easy to understand. And then the next, the third report is a cash flow statement. It's not really our focus today, so we won't talk too much about it. But basically, what this report tells you is everything about the money, everything about cash the business is using and generating. So where the cash is coming from and where the cash is going to. So it's just basically telling about the movement of the cash. And then don't worry too much about it. So it's not our focus today. And the last one is also just not our focus today either. So it's just basically telling you the movement in the owner's equity account that basically includes the return earnings, dividends, and also the share capital fund introduced into the company. Cool. So now what we will look at the next, it will be the income statement and balance sheet here. And now let's take a look at the income statement first for now. Like what I mentioned before, the income statement that tells you the business profit, how much profit the business is generating, right? Is the business generating profit or the business is making a loss? So that's basically what the income statement is telling you. And here, before we talk about the income statement, you have to understand one equation, which is this one, which is this equation. The sales minus expenses equals to profit. Of course, I'm pretty sure all of you guys should know this equation. So that's really like a common sense, right? So sales, so this is net profit. This is the goal of the business, right? The business wants to make profit at the end. So that's how to work out the net profit. That's by using the total revenue the company made during the year and minus all of the costs the company incurred during the year. And then what left at the end is the profit, right? And then if you look at is a really simplified income statement example here. So you can see this is the different years, right? Like 21 and 2020, that's fine. That's normally there are two, there's current year and last year presented at the same time in the financial statements. So if we just take a look at the content or the elements in the income statement, so we can see the sales. Of course, it's pretty easy. Everyone should know that what it is, right? So that's the sales for selling the goods or the services, right? And then how much revenue they generated during the year. And also they need to minus something called cost of goods sold. What does this mean? Normally I would like to explain in this way. So the cost of goods sold, that means a direct cost. related to sales. Or, okay, so this is direct cost. Yeah, so that's not really the accurate, really 100% correct, but it's just for understanding purpose, you can understand this is the direct cost related to the sales. Normally, that's the cost of the inventory, yeah, or the cost of the service, something like the labor cost, and directly related to the goods or the services. For example, like if you sell toothpaste, and then you sell the toothpaste for $100, and the cost of the material, cost of the chemical product is directly in this inventory, in this toothpaste is $80. And then you will come up with $20, which is going to be the gross profit. So that's the profit, the sales minus the direct cost, which gives you the gross profit. With yeah, I'm sure everyone will know what it is, right? And also, but apart from the direct cost, we also have some other costs. We also have some other indirect costs, right? Indirect cost. Something like salary expenses, like the CEO, CFO's expenses, like the management's salary is really not directly related to the sales of one particular product, right? Because the CEO or CFO, they manage the whole company. It's really hard to contribute or trace like to split the CFO's salary into each specific product, right? So now we say this is indirect cost. So that's why, okay, we put employee expenses here as an indirect cost, and also some administration expenses. Yeah, so that's can be indirect cost as well, like electricity in the offices, in the headquarters, is not really used for the production of the inventory. So it's not really a direct cost, right? So normally like the electricity, the water bill, or the cleaning fee, for the headquarters, it will be included in the administration expenses as an indirect cost. And also, of course, like selling and distribution expenses and some other operating expenses. So at the end, after deducting all of the both the direct cost and indirect cost, and we will come up with the net profit here. So that's the ultimate profit the company is generated at the end of the year. Cool. So that's basically what income statement is telling everyone, telling us here. Okay, it's really easy to understand, right? And okay, now let's move to the second type of the financial statements, which is called balance sheet. And also, like what we say, this is also called financial position, right? Financial position. Okay, and why does it tell us the position? And what do we need to know about this company's position? So there are basically three elements we need to understand. They are assets, liability, and equity. And here also, before we take a look at look at this example in details, we have to understand this equation as well. So that's the relationship between the assets, liability, and equity. So apparently what is showing here, what is showing in this equation, that's assets minus liability equals equity. And why? Okay, so let me explain it in this way. So if you change this formula in a different format, you can also change the formula into this way, right? So assets equals to liability plus equity, right? So you basically just move the liability to the side, right? So assets equals to liability plus equity. So what does this mean? It basically means the assets, that's how the business is using their resources. Basically how the business is, where the business is using their money to. And however, on the other side of the equation, the liability plus equity, it tells you where the source of the fund coming from, the use of the fund. This is asset, and on the other side, liability and equity, they are the source of the fund, right? And then the liability indicates creditors. For example, like bank loan, right? The bank will give advance the loan to the business, right? So that's where the money coming from. So the business is getting the money from the bank, right? So that's the source, one source of the fund. But this source is in the form of the liability. And on the other hand, equity, that's also we need to get money from somewhere else, right? But who are we getting the money from? We're getting the money from shareholders, right? So that's in the form of the equity. So that's basically the liability is the money coming from the creditors or the bankers, and then the equity, it means the money coming from the shareholders or the owner of the business. And then, okay, so now let's come back to the assets. So assets is where the company used this fund, right? Used this money. So they spent the money on the fixed assets, on the inventory, and some cash left in the bank account. So this is how I normally will explain this equation to everyone. Okay, so now let's take a look at the balance sheet in details now. So also if we take a look at the example showing here, and then we can see this is assets, right? And this is liability, and this is equity, right? So if we look at this, total assets is this much, right? And then total liability is this much. So if we use the total assets minus the total liability, which gives us 940, and then that equals to the total equity. That basically just explains what we just mentioned in this equation just now, right? And okay, so now let's take a look at the assets here. So if you look at the assets in details, you can also see it has been split to two sections, right? So one is called current assets, another part is called non-current assets. So what's the difference between those two? So current assets, that means, what does current mean? The current means it's liquid. It's liquid. So normally that means this is the assets will be used within next year. It will be in next year, in one next year. Because we consider that as a short term, 1 year. Next to 1 year, it will be as a short term, and then the assets will be used in next year. That's liquid. So that's why we'll be classify these assets as the current assets. So what is included in current assets? Of course, cash will be current assets. It's the most liquid assets, and also accounts receivable. It will be current assets as well, and then of course the inventory as well. So that's basically the three typical accounts in the current assets. Okay, now if you look at the non-current assets, so as a contrast, right? So the non-current assets, it just basically means you're gonna use these assets more than a year, right? So it's not liquid, not as liquid as the current assets, and then it will be used more than 1 year, right? And then what's the example here? The example will be property, plant equipment, and intangible assets. So if you buy, for example, like a plant, or like some equipment or machines, you don't really just expect you're going to use the machine for a year, right? You're going to expect to use this machine for more than a year or even longer, like maybe 5 years or 10 years, right? So that's will be sitting in the non-current assets here. Cool. So that's basically what the different types of assets account just now. Okay, now if you look at the liability, so liability also has current liability and current liability. So current liability still, that's liquid liability, right? You need to pay in the next year. That normally includes accounts payable, accrued expenses, and short-term loan. And so some people may get confused. What's the difference between accounts payable and accrued expenses? So it's really easy to understand. So apparently, the only difference is accrued expenses is the estimated payable, accounts payable. So give you guys an example. So accounts payable, that's the payable, you have received the invoice, but you haven't paid yet. So that you know the payable amount, the exact payable amount already. But for accrued expenses, you haven't received the invoice. You have to estimate an amount and to accrue this expense at the end of the year. Something like the salary. So for example, you pay the employee on the 20th of each month, and then but when it comes to the end of the month, it will be the 30th the month, right? And then there are 10 days. There are 10 days you haven't paid the employee salary yet, and then you have to estimate how much salary you will be about to pay from the 20th of the month to the 30th of the month. So during those 10 days, so you need to estimate the salary accrued salary expenses during those 10 days, right? So that's a really estimated amount. So it's not really confirmed. It's not really confirmed by invoices or supplier, but because you need to reflect all of the economic transactions or economic activities of the business, so you have to accrue these expenses. Okay, so that's the liability as well. So that's the difference between accounts payable and accrued expenses. And okay, cool. Now let's look at the next one. Non-current liability. That will be also the liability you need to pay more than a year, right? So it can be like long-term loans. Just really typical example. And at the end, okay, now we come to the equity section that basically just includes the contributed equity and the retained earnings. So the contributed equity, that's the money coming from introduced by the shareholders, right? Which like what we just mentioned. And the retained earnings, what is retained earnings? Retained earnings is the profit, accumulated profit hasn't been distributed to the shareholders. So that's that is the definition of retained earnings, and also that will be sitting in the equity section as well, because that's the interest pertains to the shareholder. Okay, cool. So that's basically everything about balance sheet. And now let's look at the third part. That's the financial ratios. And why do we have to look at financial ratios? Like I mentioned before, financial ratios is really important part of the financial analysis, because like what I said just now, like the data doesn't really create value. Only information can help us to make decisions. So apparently what we need to do, for example, if you only get the financial statements like balance sheet, income statement, it means nothing. Because why? Because you have to do the analysis based on the numbers in the income statement and balance sheet, and to help you make decisions. So this is what you need to do. So financial ratio analysis is what you need to do after you get the income statement and balance sheet. So now let's take a quick look here. So what I gave you guys here, there are three types of different ratios here. So the first one is called profitability ratio, and the second ratio is the efficiency ratio, and the third ratio is the financial leverage ratio. Of course, this is not really like a exhaustive or complete set of the types of financial ratios, because there are heaps of different types of financial ratios. But here I give you guys three different types. They give you three types of ratios which we normally use. Okay, and okay, so now let's look at the first one, profitability ratio. And then it's really easy to use this ratio. And then what this tells us, it just basically measures and evaluates the company's ability to generate profit. And then here there are two ratios you can use. One is the gross profit ratio, another is the net profit ratio. And how do you work out? You use gross profit ratio divided by sales, or the net profit divided by sales. And then if let's go back to the income statement. So currently what we need to use to do, the number we need to use. So we use gross profit divided by sales. That gives us the gross profit ratio, or the net profit divided by sales. That gives us the net profit ratio. And why do we need to look at this? And what does this mean? So this basically means for every $1 sales, how much profit you will generate. For example, if we say the net profit is 33%, what it actually means, the 33% here, that means every $1 sales, the business will generate 33 cents profit. Of course, the higher the ratio, the better it is, right? Because we want to see the company is being profitable. Yeah, so this is how we're gonna use this ratio to make decisions. Okay, I'm gonna show you guys a little practice later on, so don't worry too much if you don't understand now. And also the second one is the efficiency ratio. That basically measures the company's ability to use their assets to generate income. And then what's the formula here? So for example, the assets turnover ratio, we basically use sales divided by total assets. And of course, let's say if we say it's like the turnover ratio is three times. Okay, so if we say sales divided by total assets is 3 equals to 3, what does it mean? It means every $1 assets in this business can generate $3 sales. And of course, it's the same thing. We want to see the higher efficiency ratio. Why? Because the higher the ratio, it means the business is more efficient. So this is how we're going to use the efficiency ratio. And then the third one is called financial leverage ratios. So that basically measures the firm's financing ability or the ability to meet their long-term obligations. And how to work it out, we can use total assets divided by total equity. So it basically means it's also called like the equity multiplier. So how many times the assets compare to their equity? So let's say if their assets divided by the equity equals to 2, it means 1 is equity, right? And 1 is liability, right? So the total assets equals to 2. So 2 divided by 1 equals to 2, right? So, and also, how do we use this ratio? It's not necessarily the higher the better, but from the shareholder's perspective, we can say the higher this ratio, the better it is, because the higher the ratio, which means the shareholder, they are trying to leverage their debt to the maximum amount. So which means they leveraged the company's ability to borrow as much as possible, borrow the maximum amount of the debt and to grow the business, right? That's from the shareholder's perspective, the higher the better. Okay, cool. Now at the end, we're gonna do a little practice based on these ratios. So what I did here, I just calculated all of the ratios based on the income statement and balance sheet I showed you guys. So here, if we look at the first one, that's the profitability ratio, right? That has gross profit rate percentage and also the net profit percentage. That's the gross profit ratio and net profit ratio, basically. And what we can see here, so if we compare the 2 different years, and then the gross profit percentage is current year is 33% and last year is 34%. They are quite similar, right? It's really consistent. So I don't really see there's a problem. And also in addition, rather than comparing the different years in the same business, we also need to compare the industry to the industry peer benchmark to this firm as well, right? So now if you look at the industry average is 33% as well, and also it's really consistent to what this business, what's the results of this business, right? So apparently based on the gross profit percentage or gross profit ratio, I don't really see there's a problem. So we just say it performs on average. It performs just as same as other peers in the same industry. Okay. However, if we take a look at the net profit ratio, okay, now there's going to be a problem. And what will be the problem? First of all, if we compare the net profit percentage, and then we can see it declined from last year. And also remember, we said we want to see a higher profitability ratio, right? So the decrease of the ratio is not what we want. It means the business is becoming less profitable, right? So now the management need to think about what's the reason. So what's the reason? So the reason must be, it must be here. It must be something wrong from here, from indirect cost. Because we say the gross profit ratio is okay, right? So now the problem is in the net profit ratio. So now what's the problem? If you look at this number here, so apparently the reason is because administration expenses coming from administrative expenses that increased heaps. It increased by 100 million compared to last year. And now that's how we can use the ratio to identify the problem and to notify the management to take actions and what we need to do. Yeah. So that's basically what we can tell from this net profit. It decreased is because the increase of the administration expenses, and also compared to the industry, it's also the same thing. Is actually lower than the industry, which is also not what we want. So we want to see a higher profitable ratio, right? So also this is what the management need to think about and to find out the reason and to think about the solution. Okay. Now that's basically the example about profitability ratio. Now let's look at the asset turnover ratio. It's the same thing. So we can see, let's compare the different year first. So the current year decreased compared to the last year. So which means the business is not using their assets efficiently, right? As efficient as last year. So the business need to think about what's going on here. Okay, now let's go back to the balance sheet here. What's going on here? So either two possible reasons, right? Either the sales decreased or the assets increased, right? So now let's see the sales. Actually, the sales increased. So it's not the problem regarding the sales, right? So now it must be another reason, right? Because the assets increased. So if we go back to the balance sheet and let's look at what's the problem. Okay, here inventory, right? Inventory increased a lot compared to last year. Increased from 500 million to 900 million. That's basically almost doubled, right? So that's the reason resulted in the decrease in the assets turnover ratio. So now the management need to think about, oh, there must be something wrong in our inventory management system, and does it mean we should? Why do we suddenly have such a high inventory balances at the end of this year, right? And then does it mean should we maybe do some promotion like program, maybe try to sell the inventory at a discount value? So that's and to reduce the level of the inventory. So that's all of the solution the management need to think about based on the ratio analysis. And lastly, okay, I'm gonna quickly just go through the financial leverage ratio as well. So compared to the different year in the same business, so it remains as a two times. So assets is the 2 times of the equity. So that's okay. It's really consistent, right? However, if we compare to the industry, the problem is here. The industry is way higher, right? It's way higher than this company. And what does this mean? So it means the company, they should leverage debt more. They should borrow more debt to increase the liability and also to increase the assets and remain the equity the same. And at the end, they can grow the business with the same amount of the equity, but also grow the business. So this is what we can tell from here. So apparently this ratio analysis, the business need to borrow more money from the bank or the creditors and to grow the business. At the same time, remain their equity the same. And then to generate a higher profit, to generate a higher return for their shareholder at the end in the future. Cool. So that's basically everything about my session, and hopefully it's going to be really helpful for you guys. And sorry for taking too long. So now I'm going to pass my session to Helen, and she's going to talk about the tax part. Thank you, guys.
Thanks, Martin, for the great accounting session. I find that it's really practical.
Oh, thank you.
And hi everyone. I'm Helen, and I'm a senior associate working at PwC Financial Advisory Service team here in Auckland, specializing in corporate tax and tax M&A. I think as a brief introduction of my team, we provide all sorts of services. Our corporate tax team helps large enterprises and multinationals solve their pressing commercial and tax issues, while as our private business team help grow business and family wealth. Our global tax and M&A team provide assistance with cross-border tax matters, tax due diligence, tax structuring, and transfer pricing. We also have dedicated employment advisory team and a GST custom team to provide support in those specialized tax areas. Not to mention our executive reward and immigration services. I guess my key point here is that tax is not boring at all. Because tax legislation is complex and continually changing, and as you can tell from the above, all sorts of services PwC offered, it's impossible for me to cover them all today. So I'm going to focus on two key tax types, that is income tax and GST, by walking through some fundamentals. I think these are also most relevant to individuals like us. As a starting point, before we can calculate our taxable income, Martin, thank you. We need to understand and apply two key tax concepts, that is residency and source of income. It's worth noting that the term residency for tax purposes is different from residency for immigration purposes. You are a New Zealand tax resident if you have a permanent place of abode in New Zealand, or you have been in New Zealand for more than 183 days in any 12-month period. The test for establishing residency is an either-or test. That is, you become a New Zealand tax resident when the first of the above happens. New Zealand tax residents are taxed on their worldwide income, whereas non-residents are only taxed on New Zealand sourced income. So let's apply this concept to ourselves. Are you considered a New Zealand tax resident? What is the source of your income? Once you determine that you are a New Zealand tax resident, or you are a non-resident but have New Zealand sourced income, you need an IRD number for any tax-related obligations you have or entitlements you get in New Zealand. Some common examples of when you need an IRD number include earning income, for example, from a job, benefit, or investment, opening a bank account, joining KiwiSaver, applying for a student loan, or buying, selling, transferring property in New Zealand. Now we can start thinking about our income tax position. New Zealand operates a self-assessment tax regime. This is based on the idea that taxpayers have the best information about their own activities and are better placed than Inland Revenue, that's the revenue authority here, to assess their income tax liabilities. This is performed by lodging an income tax return, which involves making an assessment of their own taxable income and income tax liability. So if you get paid a salary or wages, your employer will deduct tax and the AC earners levy before they pay you. We normally call this tax deducted at source. So these deductions are known as PAYE, pay as you earn. You can ask your employer to deduct other money from your earnings before they pay you. These deductions could include, for example, student loan repayments, your contribution to your KiwiSaver account. Your employer may also contribute your contribution to other retirement savings schemes, child support payments, or donations to charities and similar organizations. These are known as payroll giving. Other income is not taxed before you get paid. This includes, for example, self-employed income, rental income, income earned as an independent contractor or from a partnership, or overseas income. So if you earn any of this other income, you need to report to Inland Revenue when you file your tax return, because they will not have record in their system. Martin, can you please the next page? Tax rates are used to work out how much tax you need to pay on your total income for the year from all sources. Individuals pay progressive tax rates in New Zealand. This means you pay a graduate amount depending on how much income you get, as you can tell from this table here. As you may already be aware that from 1st April this year, the new 39% marginal rate applies to all employment income over 180K, including extra pay earned in the course of employment, such as bonuses, back pay, redundancy, and retirement payments. The next question is how often we pay tax. You would have to pay provisional tax if you had to pay more than 5K of tax at the end of the year from your last return. It was 2,500 before the 2020 income year, but the threshold has since been increased in light of COVID-19. Provisional tax helps you manage your income tax. You pay it in installments during the year instead of a lump sum at the end of the year. There are 4 methods for calculating that, and the default method is the standard uplift method. For example, if you have taxable income of 66K, which I assume is a mix of salaries and other income, the tax liability is calculated as 13K, which I use the table at the left. Your employer has already deducted PAYE of 8K from your salaries, and you will still have 5K of registered income tax to pay. You will also have to pay provisional tax of 5,205 in installments for the next year, based on a formula here, which is an uplift of 5% of this year's registered income tax. I believe this should not be applicable to us because the majority of our income is salaries and wages. But if you do have all sorts of other income I just mentioned, you will need to pay provisional tax. And now let's moving on to GST, Goods and Services Tax. It's a tax added to the price of most goods and services, including imports. It's a tax for people who buy and sell goods and services, and is charged at a rate of 15%, as you all could see from the invoices you've got. You might need to register for GST if you sell goods or services. You must register if you're carrying out a taxable activity and your annual turnover was or will be more than 60K. So taxable activity is any activity carried on continuously or regularly that supplies goods and services to others for some form of payment, but not necessarily for profit. For example, many clubs run regular sporting competitions, and these competitions are part of the club's taxable activities. For charities, running opportunity shops are considered carrying on taxable activities as well. So as soon as any of these things apply to you, you must register for GST within 21 days. If your annual turnover is less than 60K and you don't charge GST in your prices, you don't have to register for GST. You may wish to voluntarily register. The advantage of voluntary registration include, firstly, you can claim back GST on expenses. Also, completing regular returns helps keep your records up to date and accurate. However, once you register for GST, you need to account for GST and comply with all the GST requirements, such as filing returns and making payments on time. So it would be time consuming. It's also worth noting that GST is it's not charged on exempt supplies. So the examples of exempt supplies include financial services such as bank fees, donated products and services, which are sold by not-for-profit organizations. And a common one is the rent paid on a private home, that is, rent paid on a residential property rather than a commercial property. I'm sure I'm not the only person here who buys stuff online from overseas every now and then. From 1st December 2019, offshore sellers are required to register and account for GST at 15% on supplies of low-value imported goods, which is on the New Zealand dollars of 1K. sales to New Zealand private consumers like us in a 12-month period exceed 60K. The 60K threshold is the same GST registration threshold that applies to domestic businesses and offshore supplies of cross-border remote services. To close my part, I think there's no escaping the fact that tax is a big part of accounting. And during my past year working as a tax professional, I can assure that tax is not boring, although the tax legislations are highly technical and some would say unnecessarily complicated. So people find tax daunting. I think the quote here very well summarizes what tax is. Tax is not boring. Tax is politics. Tax is geography. Tax is social issues. Tax is financial literacy. Tax is financial empowerment. Tax is problem solving. Tax is helping others create a stronger sense of independence. Tax is anything but boring. I would also add that tax is challenging as a professional. It's also evaluating information, arriving at creative solutions, hand-holding, standing up for rights, explaining, challenging views and assumptions, and keeping on top of rapidly changing legislation and commercial landscapes. Thanks for your attention. Now I'm handing over to Sichen for the Q&A session.
And thank you, Helen, for that very insightful and engaging session. Before we started the session, we were able to reach out to our members and other followers via many social media platforms, and people have put together some questions for Martin and Helen. So perhaps we'll start by some questions. I think these might be suited for Martin, but feel free and chime in if you have any comments, Helen. So the first question is, generally, how do financial statements differ across countries? Is there much difference country to country wise? And obviously in New Zealand, people follow the NZ General Accepted Accounting Practices, but is that the same elsewhere or globally?
Yeah, that's cool. That's a really good question. So I think we always get asked this question. Oh, I got a business by our clients, because they say, oh, our business is operating in US, and what's the US financial reporting standard, and what's the difference to the New Zealand one? Can I just use the New Zealand standard to prepare the US financial statements? Unfortunately, the answer is no. So you can't. It's different. It's totally different standard. So, but broadly speaking, there are two, at the really high level, there are two, the worldwide, there are two different schemes regarding the financial reporting framework. So one is coming from UK, that's called International Financial Reporting Standard, that's called IFRS. And another is coming from the US government, that's called the US GAAP. So this is globally, there are two major different schemes. So you can't use the IFRS standard to prepare the financial statements, and you can't use the IFRS standard statement in the US. It's totally different, and also it's not allowed to use the different regime standards in another country. So yeah, so this is also like speaking of our New Zealand. So our New Zealand is really close to IFRS. Apparently, to be honest, I would like to say 99% in New Zealand, the accounting standard in New Zealand is as same as IFRS, because it basically just stems from the IFRS in UK. So and also IFRS, that's the UK standard. That's the most widely accepted in the world. I think it's around 100 each country using IFRS as their accounting as their own regime accounting standard. But however, for US GAAP, that's basically only from my knowledge, I think it's only applicable in America. So and also therefore like basically, and also there are some other countries like China, Japan, Korea. They also you have their own regime standards, but the majority also stems from the IFRS, and also like China, Korea, Japan, they made their own adjustments, a bit more adjustments to the IFRS. Yeah, so to the US UK standard. Yeah, so that's every country is different, but speaking, there are two major schemes. Like IFRS is the one is the US GAAP. It's basically only applicable in America. So did I answer you guys' questions?
I think so. Sorry, just show my internet connection is a little bit unstable, but looks like we are back now. And I guess this also is a constant reminder that you should always seek professional help based on the various countries you are in.
Yeah, definitely. Yeah.
And also following on the many points you touch on, Martin, I guess if you were to say there's one key point you should look at in relation to balance sheet, income statements, when looking to invest in a company, what would you say is the most important thing that you should be looking at?
That's a good question, but that's also a really hard question because you can't really look at financial statement only based on one number, because every number in the financial statements, they are linked to each other, because we say the relationship between the within the financial statements, we call the relationship as linkage. So it's really hard to say, if I just only look at one number and if I just want to use one number to make the investment decisions, it's really hard, to be honest. But still, I would like to quote one of the really famous PE firms manager, and he told me, if you really want to look at one thing, what you really need to look at is the profit. It's basically the income statement profit. So in another words, if the business can generate profit or sustainably generate profit in the future, which means the company value will grow in the future. Yeah. So, and also here, profit sometimes also refers to EBITDA. That's the earning before interest, tax, and depreciations. So that's that's another word of profit. So I think in the investment world, we normally look at EBITDA actually rather than profit, but it's a kind of like the same thing, but not really. But if you really want me to give you one thing, an answer, I would like to say the profit is the only thing, is the key thing we need to look at in the financial statements. Yeah.
So that will no doubt be very helpful to our members looking to invest. And one last question. What are some things you will look for in financial statements when assessing an entity's going concern assumption?
That's a really good question as well. So that's basically what that's what you need to rely on. You need to rely on the cash flow statement. Yeah, that's gonna give you the most of the information about the company's going concern. So when we are saying the company is not going concern, that basically means the company has no sufficient cash to run the business. So there's a the chain of the cash was broken. So that will result in the business becoming not going concern. So, but we didn't really talk about the financial statement, the cash flow statement much today. But so what you should refer to regarding the company's going concern issue, you need to look at the cash flow statement that tells you if the company is generating enough cash and if to cover their cash payment during the financial period. Yeah.
Thank you very much for that. And we've also got here some tax-specific questions for Helen. So one of the members have read online that foreign services provided to a GST-registered New Zealand company are zero rated for GST under the remote services provision. I'm not sure how familiar you are with this, but you think you can advise what the purposes of this provision is, and if so, what are the general requirements for this to apply?
This is really good and technical question, and I think this member should join us, particularly the GST team. Although I'm not a GST specialist, I did consult with our GST team before this, because I try to give you, like your member, like a proper, not an advice, but just a view. So the remote services rules were introduced in October 2016 and require non-resident suppliers of remote services to register for and return New Zealand GST to Inland Revenue, where they make supplies over the 60K, which is the same threshold for compulsory GST registration for domestic businesses. The rules are designed to capture B2C, which is business direct to consumer supplies, and B2B supplies, which is business to business, are carved out unless the parties agree to charge GST or other limited criteria are met. Note the supplies are not zero rated. They are not subject to GST at all, and outside of the net. Broadly speaking, the purpose of largely excluding B2B supplies is that registered businesses in New Zealand are entitled to claim back the GST they incur as part of their taxable activities. And claiming on supplies from non-residents creates a compliance burden. I think that's more about like the commercial reason. Yeah. I hope that answered the question.
Yes, it is indeed a very highly specific and technical question. So I'm very grateful that you're able to shed some light on this aspect. Lastly, I guess to end this off, obviously we are in a period of quite a few tax changes, and obviously you said it's very volatile. Can you possibly discuss one or maybe a few changes that you think are probably the most relevant, or something that we as young professionals, students should pay attention to?
Sure. Yeah, there are quite a few tax bills enacted recently, and I think I've briefly talked about the new 39% tax rate on income over 180K, although that's not that relevant to us yet. I think another hot topic I can think of is the property tax change, because I also get asked quite often by my friends who are rich, like can do a lot of investment. So this includes extending the bright line test to 10 years. So it's currently 5 years, and also disallowing interest deductions on residential investment property. The purpose is to help address housing affordability here in New Zealand, particularly in Auckland, I think. Before the changes, I think people tend to borrow money from the bank to fund the purchase of a residential investment property and then claim the interest charge on the bank loan as deductible expense, which would effectively reduce their personal income tax liability. And from 1st October 2021, so this October, interest payments on residential investment property acquired on or after 27 March will not be deductible, with the exception of new builds. Interest on loans for properties acquired before 27th of March can still be deductible, but the amount that can be deducted will be reduced over the next 4 years, which means that for the 2026 income year onwards, the interest payments will become entirely non-deductible. In addition to this change, residential properties acquired on or after 27th of March will be subject to income tax if disposed of within 10 years, except for the new builds, which will continue to be subject to a 5-year bright line period. I think this is to encourage increase in supply. My suggestion here is if you would like to know more about this, and I would suggest having a look at our text tips at our website, which provides the latest insights and commentaries. Yeah, that's all. Thanks.
That is definitely something very useful and helpful, especially in this very hot housing market. Looks like new builds are definitely the way to go. And that's our Q&A section. I'll pass it back to Ellen, who will conclude this.
I actually had a quick question for you guys as well. How's AI and artificial intelligence kind of changed the way you guys worked throughout your few years at UC?
I always get this question from the uni students.
I think that's one of my assignment, the topic. Yeah.
So actually, last week we just came back to uni for one of the career campus event, and one of the students asked me exactly the same question, and she asked me, "Oh, will accountant or be replaced by automations or data analytics?" And from my personal perspective, my personal point of view, I don't think so, because I just give you guys one example. So let's say the time before Excel and after Excel. So like before, like maybe like 20 years ago, our partner, they do everything on paper manually. They write everything down. But when they get the Excel, the accountant are still here. And then the Excel only changed the way of doing accounting. So it doesn't really replace accountant. It does, and also still it makes the accountant or the accounting even more important in the business world, because the volume of the data is getting higher and higher. And we need more, definitely we need more advanced technology to handle those data. But still, like what I just mentioned, we still need people to use these tools, to use this advanced technologies. So, and also just still, like, accounting is not only about recording transactions, it's also about doing the analysis. And this is gonna be always a human being's work to make the analysis and to make decisions. So that's basically my point of view regarding your question. So I don't really think AI or automation will replace accounting. It will only change the way of doing accounting.
Yeah, I totally agree with Martin. I think same applies to tax.
Yeah.
Like the advice we've been given to our clients is always based on their specific facts and based on like the unique background, and we need to look at the legislation, very specific one, and it's the legislation itself just keeps changing. I think for the tax consulting part or advisory part, AI can never replace tax specialists. But I agree that AI or technology can definitely assist the tax compliance side, the process. So a big change for our team is just before COVID lockdown, we managed to move the filing to like e-filing, not like paper or like we will file like additional documents like financial statement stuff, tax calculation, via post to inland revenue. But just before that, we upgrade our system and we can just do like e-file and everything online. Mm-hmm. So I think like I've been seeing a lot of changes in my team as well in terms of using technology to facilitate the delivery of the tax compliance work.
Yeah.
But I totally agree with what Martin just said.
That's really important, because but still it's really important to be aware of the digital disruption. So that's why we for all of the professionals in our firm, and we need to be aware of this disruption, and we need to upgrade our skills and to cope with the client, and to to provide a better service. Yeah.
Awesome. Thank you so much, guys.
Yeah.
And I think it was such a great seminar. It was, to me, and I'm sure to others listening, it would be quite a good refresher on accounting fundamentals, but also, learning about the new tax legislations and structures that are coming in place as well. So I'd just love to thank the both of you for taking your time out of this evening to present to us your insights and your findings. So yeah, thank you so much. Cool. And just to end it off, so we really hope you guys that are listening out there that you've enjoyed this event, and stay tuned for the next part of our development series, which will be looking on to the networking side of things. So our guest that we'll be having at our next event will be David Nottage, who is one of the world's best presenters, who's overcome many challenges from someone who has been too scared to, speak in front of more than 4 people to over captivating over 2,000 Toastmaster members. So this will be a live Zoom event session where you'll have the opportunity to learn the tricks of the trade and ask David questions on how you can overcome social anxiety whilst networking and presenting as well. So thanks for your time, and please do follow us on our social media, Facebook, Instagram, and WeChat and LinkedIn, and I hope to see you guys at the next events.
Good. So thanks, guys.
Thank you, guys.
I hope to see you guys in person in the workshop in the future.
Yeah.
Good.
Thank
See ya.
you.
Bye.
Bye.